What's going on, YouTube? Welcome back to Goofy Investing, where we talk about investing in the stock market. This video is going to be about a stock that I am buying in the month of September, Navitas, ticker NVTS. This is a semiconductor company that specializes in the next cutting edge silicon microchip technology. And as far as NVIDIA, they are the cutting edge of today, and they have the actual capacity to support the infrastructure of more mass scale. As opposed to Navitas is a baby company, which is, I believe, going to be the next NVIDIA, AMD, if you will, in the next several years out, maybe a couple decades. Who knows? So let's talk about Navitas, some things that I'm seeing, some buy strategies, and so forth. Year to date, we're down 68.28% on the stock. For stock price action, on the 1 year, we're down 66.97%. And on the max, we're down 78.98%. One of those SPACs one of those IPOs that was coming into the hype of the EV market. Navitas has 4 different sectors of business model revenue that contribute to the revenue, if you will. One is going to be microchips in actual cell phone chargers. Another one is going to be your solar panel inverter microchips. Another one is going to be in data center microchips. And another one is going to be in electrical vehicle sales. 3 of those business models, your solar, EV, data centers, with the high interest rates and the actual stunt in growth in the U.S. economy, these actual different sectors within the revenue pie, if you will, are down dramatically, and Navitas has taken a big hit. The one side of revenue that is pretty much keeping this company afloat is the actual cell phone charger microchip revenue. And that's keeping them to have positive revenue and keeping their business afloat and so forth. Let's go to profitability. If you look at these margins, I assess that these margins are contracted because of those 4 sectors of Navitas's business model. 3 of those are high margin business: the EV, data center, microinverter, microchips that go into the inverters for the solar panels. Those are high margin products that sell very expensive, as averse to the actual cell phone charging microchips, which is low margin. Due to the actual business model and where a portion or most of the chunk of their revenue is coming from the actual those microchips going into cell phone chargers, because that's low margin, it has definitely hit Navitas's margin to see contraction. When I see a contracted margin on a stock, I see a tailwind of opportunity in this actual environment and this actual situation. The Fed will start lowering interest rates and will be a elongated tailwind to soon creep up for years to come. And as Navitas gets more business in those other sectors of revenue, once again, the solar panels, EVs, or the microinverters for the solar panels, EVs, and data centers, these margins will expand, increasing profitability metrics, and Wall Street analysts will start targeting and awarding a multiple based on this margin expansion. That's just one of the many tailwinds that I see. Moving on to earnings estimates, okay? As you can see, going down here, all right, 12.91% year-over-year growth projected. The let's look at their actual 5-year growth. Well, we don't have an average 5-year growth, but typically Navitas has been delivering between 50 and 100% on their growth metrics. Going back to the estimates, we're set to reaccelerate revenues in 2025 and so forth, to reaccelerate even more 2026, 2027. In terms of profitability, Navitas is a ways away from profitability. For them to actually hit profitability, management has guided that quarterly revenue needs to be in the 50 millions per quarter for them to start breaking even on profitability. All right. Let's look at a quick little snippet of their actual their balance sheet. So still got plenty of liquidity right now, 112 million, well 103 if you subtract that tiny amount of debt. If you go to their net income, all right, go to the financials, the cash flow statement, net income is still negative. You see dramatic spikes going up and down year over year. One year they made a little money, another year they lost a lot of money, and so forth. This company is burning cash. This is a high risk, high reward investment. One of the saving graces that I see to kind of stop the bleeding is they have these free cash flows, and a lot of these free cash flows are going to be derived from these total cash and short-term investments of 112 million. Now, when you look at the balance sheet and you see a company that has total cash and short-term investments, when you look at the short-term investments, all right, that means that these are investments that are liquidatable within 1 year, all right, within a year and under. That's what qualifies as short-term investment. Different CFOs will put this cash on the balance sheet, and they'll invest that cash in different derivative instruments, maybe so far credit-backed securities, or maybe dated bonds going out 1 year, or quarterly bonds to actually shuffle to the right or continually be getting punted to the right. As the interest rates go down, and it's going to take a while, we'll see how fast the Fed is willing to cut. As the interest rates go down, it will be a lag of a headwind towards their total cash and short-term investments. But it's nothing compared to the actual impact it would have on the business model. So the point of friction of that lag, we'll have to see how that timing comes along. I project their cash burn. They will burn this cash and have to do another raise via equity or debt. They will probably use equity. Once again, high risk, high reward. I'm going to have to eat the dilution, and I'm okay with it. All right. I see something in this company. I believe in this company more than most. Okay. Same thing with a lot of these other investments. It's my job as an investor to take the risks that nobody's willing to take as I see appropriate. Now, that doesn't mean I'm going to go to a craps table and put everything on a number or something. But getting exposure to this industry, doing my research, Navitas fits my style. Their business model is really wild compared to the other semiconductors. It looks like and appears that they're very hungry. Their management is very competent and know what they're doing. They have this new CFO. We'll see how she performs. It seems like she's doing a good job so far. We got this Chief Technology Officer, Dan Kinzer. I'm pretty impressed with him and Gene Sheridan, of course, CEO and co-founder. I think he's really good. All right. So management seems to have their head on straight. Let's talk about some other angles to this. All right. Let me pull up my portfolio here real quick. Just get this over here. Bear with me. I'm going to expand for visual effect. All right. So as you can see, Navitas is the one in my portfolio taking the most hit. All right. Looks like we're down 23.19%. I want the stock to keep going down as I'm buying this, okay? As a growth investor, all right, where do you find alpha, all right? You find alpha when you're in the situation where other growth investors are looking at you like you're crazy, all right? When everybody wants to sell, it's time to buy, all right? Um, one of the things is your character, discipline, all right, sacrifice, and delayed gratification. This is what gets the alpha, all right? It's part of my style. You see, this growth is down. Wall Street and everybody is short term. Everybody wants the stock to pop, all right? Well, it doesn't work that way all the time. So, as a growth investor, if the economy is slowing down and there is lack of growth, all right, that's a problem. All right, someone like me is solving the problem, investing in growth when there is none. All right, this is how you're going to get the best prices. This is this is how you're going to be rewarded with exponential multi bags years down the road. I can see Navitas 20xing for me. Let's do a review on some position buy lots and some strategy and how I actually tactically get in there and build a position. All right. So in January 31st of this year, I decided that Navitas is a company that I have selected to be in my portfolio. This is a very stringent requirement to come into my portfolio. I'm very picky. I'm very selective. I'm heading up to almost 100 G's and I only have 6 stocks in there. So that should say something, all right? Maybe some investors would say that's too many stocks, too many positions. Others would say you're crazy. That's not enough. You need more diversification. But hey, to each his own, okay? Everybody has their own style. Now you notice when I decided that Navitas would be part of my portfolio, I didn't just go in and start bum rushing with big buy lots. All right, I only started with a couple $100, and that's the entryway to the position. Yes, I did an assessment of their valuation when I decided that this is the company for me. And yes, I came up with the conclusion that on a price to sales ratio, they probably don't deserve to be trading at that multiple at that time. Hence why I only put a couple $100. All right. As she started dipping into the threes, all right, didn't go too crazy. 800 here, 1,000, going down more. I'll do another 1,000. Now we're in the twos. Now it's time to amp it up with higher buy lots, all right, with more chunks of liquidity and firepower, all right. So, I mean, this position will be built sooner rather than later with these buy lots. What's my intention? All right. What's my intention for Navitas in my portfolio? Well, I plan on getting Navitas up to 10,000 invested capital, capped off at the nearest 100th share. Okay. That is my style on the initial entry or building of a position. All right. And then once I get to that point, I will reassess. Do I have more time? Is everything fundamentally going my way? Do I want more exposure? And depending on price action and valuation, I may decide to double that to 20,000 invested capital or 15,000 invested capital topped off at the nearest thousandth, like you see so far. This is just my style and how I actually structurally position myself within these stock positions in my portfolio. All right. So that's something to consider. Quick plug. If you're finding value in this video, thumbs up and subscribe. All right. Check out my Patreon if you wanna participate in a community of like-minded investors and you want access to the hidden gem collection, more direct access to me, buy and sell alerts, different investor spreadsheet tools that are all included in the actual Patreon price. All right. And these are in perpetuity. So you can download these tools unsubscribe to Patreon and just keep them on your desktop if you want. All right. But I'm always continually putting in more spreadsheet tools, videos, and instructional analysis and so forth on my Patreon. All right. So that's all I got for Novitas. I hope you all got some value and insight on some actual different angles of how I see things as a growth investor in these little small cap growth stocks. But with that being said, thank you all for your time. Thank you all for your support, and enjoy the rest of your weekend.